From the morning reading, the Spider gives back gains following the FOMC announcement. 4 of 9 sectors moved higher on Wednesday. XLB, XLY, and XLF were the strongest sectors, while XLV was the weakest sector. Oil futures fell for the 5th straight day, 41 cents to close at 47.49. Breadth strengthened as advancers led 1825 to 1181 on the New York Stock Exchange and 1366 to 1205 on the NASDAQ. The Spider traded higher through the FOMC announcement up until the last 30 minutes of trading when the Spider dropped $1.25 to close down 29 cents for the day. A late day fade the Fed session. Indeed, global equities had a strong day in advance of the afternoon FOMC announcement and Chair Yellen's press conference. Prior to the 2 p.m. Eastern Fed, U.S. equity markets were trading higher, albeit modestly. The benchmark S&P 500 opened in the green and traded in a remarkably narrow range until the final hour. The trade immediately surrounding the 2 p.m. Eastern event was unusually subdued, marked only by an undramatic 0.5% intraday high when the statement was released. The market resumed its sideways trend until the final 30 minutes when it suddenly dropped into the red, closing with a 0.18% loss, which is a bit above its negative 0.27 intraday low shortly before the final bell. The loss increased the current sell-off to 5 sessions, the longest since the 5-day losing streak that ended on February the 11th. The 10-year note closed at 1.66%, down 2 basis points from the previous session. The 20-year bond yield dropped a single basis point to 1.99% at a new post-recession low. And the 30-year bond remained unchanged for the third session at 2.43%, which is only 18 basis points above its post-recession low. Option traders are diverging from their usual pattern. Traders key off the recent volatility to price in the amount of volatility they expect to see in the near future, but that hasn't been the case over the past week. Stock's actual movement has declined while the VIX has spiked. That has led to poor shorter-term returns in stocks, but good longer-term returns. The main S&P 500 fund, the SPY, has declined for 5 straight days. That's the longest such streak since September, a move from which the fund has typically bounced over the next several sessions. Volatility funds are leaking assets. UVXY has lost $250 million over the past 2 days, which has typically preceded a move lower in that fund and a rise in stocks. At the same time, leveraged bets are increasing against the major indices. ETFs that are leveraged bets against the S&P, the Dow, the NASDAQ, and the Russell have reached $6 billion in assets, the highest since 2011. Volume in inverse and volatility ETFs remains exceptionally high. It accounted for 10% of the total New York Stock Exchange volume on Monday, 12% on Tuesday, and 8% on Wednesday. All of these exceed prior records. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:04 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 16th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the U.S. broad market indices were up just above scratch. Crude oil, though, pretty big mover in the overnight session thus far, down over 1%. Euro up about 0.2%, bonds down just below scratch, and gold down a little over 1/3%. China is down about 0.5%, Hong Kong down over 2%, Japan down over 3%, Germany down about 0.75%, United Kingdom down over 0.5%. In terms of macroeconomic reports for today of significance in the United States, you have CPI, Philly Fed manufacturing, the weekly unemployment claims, and nat gas storage if you're a nat gas futures trader. And in terms of looking forward to tomorrow, you have housing starts. And that looks to be about it to wrap up the week. You do note that ECB President Draghi is speaking tomorrow, so that could have a potential to move U.S. markets as well. In terms of current volatility conditions, we in terms of short-term VIX, are at 22.6. So one of the morning authors mentioned about the volatility kind of going the opposite way of actual price movement as priced in by the VIX products. So you see the short-term VIX at a 22.6, skew up over 140. So that's about a 13% probability of a 2 standard deviation move in the next 30 days. That's getting about as high as we typically see. We don't normally see it much more than about 145. So that should give you some reference point. In terms of IV percentiles, not much change from yesterday. 31 on the S&P, 32 on the Russell, 24 on the NASDAQ, and 27 on the Dow. No standard deviation moves were put in on a close-to-close basis by any of the 4 broad market U.S. indices yesterday. Let's see here. Let's go ahead and go to the charts. So, of course, we had the big FOMC announcement yesterday, and the action afterwards, you had a bit of a spike up, and then that proceeded to roll over and give it all back. We did come up off the lows just before the session end, so not as bearish as it could have been, but ultimately the final end of the day price action was relatively bearish, and certainly not much of a a confidence setter for what was coming out of the FOMC. And it was kind of the typical response where it's like everybody says, yay, they didn't raise the interest rates, and then, oh, that means that the economy isn't doing so well. It's not even strong enough to go up a 1/4 basis point, off of a floor that is virtually at 0. So, perhaps that's the kind of recognition that gets ultimately taken away as people read the minutes and read the notes and all the other stuff from the Yellen's talk and the press conference and so forth. Bottom line is that we're still way below where normal interest rates would be at this point in the business cycle. And while the investor community and the institutions welcome the relatively high amount of stimulus that is in effect present with these low interest rates, and these are very, very relatively low. Yes, they're up a 1/4 point from where they were, but that is, in the big scheme of things, nothing compared to where normal would be, or really where we started. And yet at the same time, this inability of the economy to be able to grow at any kind of sustainable, encouraging rate is probably ultimately concerning to the investor community, and that's why you see the sell-off after the initial euphoria. That's my theory, at least. So anyhow, so there's the S&P, and we said we would need to wait for the FOMC announcement to see what to make of this. And ultimately, it would seem to be continued weakness, and we continue to drop into the cloud and, probably past the 50% fib at this point. And, of course, this is yesterday's candle. So on the SPX, this is your index product, so no action on the overnight. So when this opens up, we're probably going to be pushing towards this 618 fib extension. We'll have to see if that holds. If that doesn't hold, if we get past that extension, we probably go all the way down to the swing low at about 2025 on the SPX. So we're probably in for a fairly important decision point in the next day or two. In terms of the Dow, these have been running very, very similar patterns of late. And would seem to be, I'm not going to take the time to draw the fib extension here, but would seem to be already below in the futures, below that 618, and probably is signaling that it wants to go down to the 17,300 area of the Dow futures. In terms of the Russell, you see the action there continues to be relatively weak, though the lows of the last 2 days are still holding. We'll see if that continues to be the case. And then the NASDAQ breaking down in the overnight, already taken out those lows of the prior 2 days. It would also seem to be setting up for a cloud breakout to the downside and a visit back to the May lows. So the price action across the 4 indices, for the most part, nothing particularly robust or a lot of energy or momentum, but still, the bias would seem to be to the downside in all these patterns that we may see continuation. In terms of bonds, of course, have been the story, and you get closing highs. Both the last several days are all closing highs on the bond futures. And you see last night's action continued to press up, and we're coming close, very, very close, to the all-time intraday high on the bond markets. And let's take a look at TLT. In terms of the intraday session, you gave back some of that a couple days ago, but then yesterday set a new 52-week high, and then closed up for the day, even after that action reversal fade, the FOMC announcement kind of price action that you had in the indices. So bonds, as you heard one of the morning authors mention, the yields are either at or approaching post-recession lows on the various products. And let's take a quick look at gold. Gold, new 52-week high, coming in at 1316.8 in the overnight session last night, and you can see well up over the prior swing highs. So it would seem that after a really, really messy consolidation and all but breakdown kind of pattern, from there it's taken off and now done what we expected it, frankly, to do all along, after something of a shakeout in between. These gold patterns continue to be technically very, very, very messy, and then to ultimately do what they're supposed to do. So gold traders are having to exercise enormous amounts of patience, and if using options, buying extra time in order to be able to ultimately succeed in seeing resolution of these patterns to the bullish side. In terms of crude oil, of course, crude oil and equities have been in a very high correlation of late, and we continue to have session after session of weakness in crude oil. 1, 2, 3, 4, 5 closed sessions, and the 6th one starting as a negative session on crude oil. So quite a bit of give back. Let's see how we're doing with respect to the channel. Give me just a second here. Probably about there, a little bit of a poke there. It would seem we're right near the bottom of the channel, so it'll be interesting to see if this bullish intermediate term trend holds and this channel holds. If that's going to be the case, we would need to apparently come into some support right about now. And so today could be an interesting day for crude oil. And if that correlation with the S&Ps is going to hold up, could be a bit of a signal for what's going on with crude oil. One of the ways to perhaps see how that's developing is to watch the dollar. Obviously, the dollar has an awful lot of impact on crude oil, and you might, it's kind of chicken and egg, which comes first, but watch the relationship between the dollar and its price action activity and crude oil, and then that could then further give you insights as to what to expect from the S&P and whether these indices are going to come into any kind of short-term support at least and start to reverse this recent price action. We talked about crude oil having 5 days in a row. Well, you know, here you are with the S&P futures. It's starting its 6th day now with straight down after being, you know, hardly a down day for quite some time. Certainly nothing in a sequence. Let's go ahead and go to the daily report. And we did have some new signals come in here today. What has not changed is intermediate term phase opinion, still phase 5, the end short term, the break of diagonal horizontal support. That continues to be a bearish warning sign. In terms of our 3 market timing mechanical signals, the first one from IBD, Investors Business Daily, uptrend under pressure, so that's a warning sign. The GMI index is still not updated as of last Friday. That author has been away, and I can totally understand that. I periodically have to go away on various seminars and other kind of jaunts myself, and you know, you just can't always update everything every single day. You know, we'll definitely give a pass, so we understand for that. But we do need to note that this has not been updated. So if we were to actually be able to see these indexes, well, these may have deteriorated since. The stock charts decision point scoreboard, it did for the 2nd day in a row continue to deteriorate on short-term signals. 2 new signals came out last night, and both of them going neutral on the short term. So now on the short term across the various indices here, you have 1, 2, 3, 4 bearish signals and 4 neutral signals, no bull signals. The intermediate term still continues to hold on mechanically 2 bull signals, but they are approaching some critical points themselves and could start to fall soon. And of course, this is all against a backdrop of very mixed long-term signals. So the mechanical signals, which were not too many sessions ago, virtually universally biased to the bull side, have really deteriorated in the last week. In terms of position sizing opinions, we're currently at 50% on both models. 1 for portfolio and 1 based on volatility for the active trader. In terms of the intermediate term market postures, they continue to deteriorate as well, with the S&P dropping now to a 65, the Dow 63, NASDAQ 65, and Russell 69. If these fall below 50, they go to strong bear intermediate term postures. So you see the warning signs continue to build and accelerate, and this is part of what we watch as we do this each day. We don't always see enormous amount of change from one day to another, but it is the pace of change and the new indicator signals that come in that we note, and we take from that, you know, our level of risk in the market. Right now, overall hedge warning status is at level 1. That's our first level of risk assessment. So that's your caution light. So do keep that in mind. Also, other warnings in terms of strategy opinions. The VIX is outside the acceptable window to initiate new positions in option income strategies for novice traders. In terms of the cover call strategies and put selling, relatively a need to be defensive, while technically borderline acceptable in both buckets of strategies to initiate new positions for novice traders. My suggestion would be at this point to mostly think in terms of put selling spreads in a position size and scale that you are willing to own, and legging into covered calls. Even there, while the ratio opinion has not changed, it's still 3 to 2, 3 in the money to 2 out of the money strikes, and 3 low beta positions to every 2 high beta positions. I'd start to shave and shape that to more low beta and more defensive kind of scale on these positions at this point. I initiated a number of positions myself a number of sessions ago, but haven't done anything in the last couple days in terms of putting on new covered calls. I probably, much like I just mentioned, would look for put selling spreads on some of those stocks that I'm willing to own. In terms of volatility-based individual warnings, we're pretty much still a sea of red, market and decline, sharp increase warnings. Both continue to persist. That volatility ratio warning fired beautifully a number of days ago and has followed through. And as you've seen, the VIX has spiked up over 20 and has closed up over 20 for 3 sessions now. VIX spike was present a number of days ago, so we'll watch to see when that ebbs. Has not yet ebbed. VIX futures are still up over 18. That daily squeeze fired and has done exactly what we expect to happen when that fires and gives us an increased volatility. Distribution day count remained the same, and the S&P is right at its warning threshold. The skew actually up over 140. Current 10-day out up over 50 now. Actually, I think it was about 58 for the 10 days out, so well up from where that was about a week ago. And then also in terms of new highs, new lows, relatively benign. Remember, the day ended up slightly negative, but most of the price action occurred in the last 1 hour. The key intermarket risk aversion indicators, I continue to watch to see any signs of rolling back up on these indicators as signs that we might be starting to form that base and level of support, and I don't see it yet on any of these 5 ratios. In terms of sentiment, sentiment's all pretty much scrubbed off with the recent weakness and is pretty neutral across stocks, both short and intermediate term, and from the fear and greed index from CNN Money, all very, very, very neutral. Bonds and gold, though, are at a pretty high level of sentiment. And from the ETF standpoint, that TLT, obviously that's the 20-year bond, is at a pretty high sentiment. So start to watch for potential reversal patterns. One of our core portfolio strategies in the trading room has pretty significant TLT holding right now. It has gone parabolic. So you start to consider strategies and timing to perhaps protect some of those profits, depending on what your goals are with those holdings. In terms of sector specific, you could see we continue to see more deterioration, more red here and less green. In fact, we're even seeing less neutral at this point, especially in the short to intermediate term. But as we always do, we want to take a look and see where is the most consistency in performance. Well, telecom, consumer staples, and utilities. And indeed, if you look at the last 2-3 sessions, telecom and utilities have been the story, whereas some of these higher beta areas, financials, transportation, retail, continue to be most consistently weak. In terms of actual performance from yesterday, this almost looks wrong to me. I know I updated it, but makes me wonder. Well, I'm just going to leave that alone. Don't have time to check that right now. But in terms of percent change, certainly the 5-day, we're seeing a very consistent down pattern, and that would certainly line up with the fact that we've seen 5 red days in a row on the S&P. So that should be enough for today. Let's go ahead and roll down. I did send out, I will say, I sent out an email to give an alert as to some of the things that have been going on of late. And I do send out a limited number of emails. So if you'd like to get on the distribution list to get those alerts, just go to this hyperlink here, scroll down just a little bit, find this button here that I've indicated, click on that button, take the first and last name and the email address, and that'll get you set up. And then, of course, you'll also get a hyperlink to get a copy of my ebook on portfolio strategy. You can also do the same thing through your smartphone. Just text Falcon Global, all one word, to the number 22828, and that will take care of getting you set up as well. We'll scroll through the rest of these. Hit the pause button if you need more time to review something. And then as we get to the disclaimers, hit the pause button again if you need more time to review the disclaimers, and note the full hyperlink down here at the bottom to set up the full set of disclosures. In the meantime, look forward to our coming back with our next market preview, and it may be a little spotty the next few days. I'm taking a Master Naturalist course in Glacier, and as a result of that, don't know if I'm going to have access to internet or not. So just kind of keep that in mind. May miss a couple sessions on these market previews, but I'll be back on the air with those as soon as is technically possible. In the meantime, good trading, and we'll see you soon.